Let's break down Forex trading. We're going to demystify this complex world and make it accessible to everyone, regardless of their prior experience. Yes, that multi-trillion-dollar market, a place where currencies from all over the globe are constantly being exchanged. It's a dynamic and ever-changing landscape. That sounds intimidating, doesn't it? All those charts, numbers, and technical terms can seem overwhelming at first glance. But it's more accessible than you think. With the right guidance and a clear understanding of the fundamentals, anyone can participate in Forex trading. Today, I'll walk you through, step by step, the essential elements you need to know to get started. The 7 main Forex products, the building blocks of this exciting market, each with its own rules, risks, and rewards. Understanding these differences is crucial for making informed trading decisions. This isn't a jargon-filled lecture. We're cutting through the noise and focusing on what truly matters. It's a beginner's guide, designed to provide you with a solid foundation for your Forex journey. With simple examples, making complex concepts easy to grasp and apply to real-world scenarios. By the end, you'll know the difference between and the nuances of each product. Trading currency pairs, the most common and liquid form of Forex trading, futures and more, giving you a comprehensive overview of the available options, plus which might suit your style, helping you identify the best approach for your individual preferences and risk tolerance. Think of this as your roadmap, a clear and concise guide to navigate the Forex landscape. To the Forex world, a world of opportunity and potential for financial growth. Let's dive in. Get ready to embark on an exciting journey into the world of Forex trading. Let's dive into the world of Forex and explore the different ways you can participate in this exciting market. First up, spot Forex, or trading currency pairs. This is the most common way individuals engage with the Forex market. This is where most traders start their journey. It's a relatively straightforward concept to grasp, making it ideal for newcomers. Essentially, you're speculating on whether one currency's value will rise or fall against another. You're betting on the relative strength of one economy versus another. A classic example is EUR-USD, the euro against the US dollar. Within spot Forex, there are 3 main types of currency pairs. First, we have the majors, which always include the US dollar paired with another major currency like the euro, British pound, or Japanese yen. Then, there are the minors, also known as cross-currency pairs. These involve major currencies paired against each other but without the USD. Think EUR-GBP or GBP-JPY. Finally, we have the exotics, which pair a major currency with a currency from an emerging market. For example, USD, TRY, US dollar versus the Turkish lira. Majors are the most liquid, meaning they're traded in high volumes and they typically have the lowest costs in terms of spreads and commissions, making them perfect for beginners who are just starting to learn the ropes. Exotics, on the other hand, are generally riskier and more volatile due to lower trading volumes and political or economic instability in the emerging market. So it's generally wise to stick to trading majors when you're first starting out and developing your trading strategies. Understanding spot Forex and currency pairs is the foundation of Forex trading. Master this fundamental concept before exploring the more complex aspects of the Forex market. Next, currency futures contracts to buy or sell a currency at a set price on a future date. Traded on centralized exchanges, they offer transparency and structure. Big institutions use them to hedge currency risk, but retail traders can speculate on price moves too. You're not taking delivery of currency, just trading the contract's value. Futures are a more regulated, transparent way to trade currencies. Now let's delve into currency options, a versatile tool in the world of foreign exchange. Currency options provide you with the right, but crucially, not the obligation, to engage in a currency transaction. This is a fundamental concept that sets them apart from other trading instruments. Specifically, they grant you the choice to buy or sell a particular currency at a predetermined price, known as the strike price, before a specified expiration date. To acquire this flexibility and optionality, you pay a premium upfront. Think of it as the cost of insurance for your trade. The beauty of options lies in their defined risk profile. Your maximum potential loss is strictly limited to the premium you initially paid, regardless of how adverse the market moves. Call options are your go-to strategy when you anticipate a currency's value will be rising. They give you the right to buy the currency at the strike price. Conversely, put options are employed when you foresee a currency's value falling. These grant you the right to sell the currency at the strike price. If your market prediction proves accurate and the currency moves in your favor beyond the break-even point, you stand to profit. However, if your prediction is incorrect, or the currency doesn't move sufficiently to cover the premium, you can simply choose to let the option expire worthless, limiting your loss to the initial premium. Options are highly favored by traders for their clearly defined risk parameters and the strategic flexibility they offer in various market conditions. It's important to acknowledge that options trading represents a step up in complexity compared to simpler instruments like spot Forex. However, this added complexity unlocks powerful and sophisticated methods for managing risk and tailoring your trading strategies. Currency options are a great choice for traders who desire a greater degree of control and customization in their trading endeavors. Currency swaps are deals between big institutions to exchange loans in different currencies. They help manage long-term currency risk and secure better rates. Not for retail traders, but they drive huge flows in the Forex market. Good to know, even if you'll never trade them directly. Forex CFDs, contracts for difference, let you speculate on currency price moves without owning the currency. You profit or lose based on the difference between your entry and exit price. CFDs are popular for their simplicity and high leverage, but that leverage can amplify losses as well as gains. Most retail platforms use CFDs. They're accessible but risky. Understand leverage before trading, perfect for short-term speculation. Want to invest in currencies long-term? Look at Forex ETFs and ETNs. ETFs track a currency or basket and are traded like stocks, simple and lower risk. ETNs are debt notes from banks, riskier because of credit risk. Both let you invest in currencies through a regular brokerage account. ETFs are generally safer for most investors. Finally, Forex binary options high risk, all or nothing bets on whether a currency will hit a certain price in a short time. Win, and you get a fixed payout, lose, and you lose your entire stake. It's more gambling than trading with odds stacked against you. Banned in many countries due to high risk and potential for abuse. Beginners should avoid these entirely. Know they exist but steer clear. There are safer ways to trade Forex. That's your overview of the 7 main Forex products. From spot Forex to futures, options, swaps, CFDs, ETFs, and binary options, each has its own purpose and risk. The best choice depends on your goals and risk tolerance. Now you have the foundation to explore further. Which product interests you most? Drop your questions in the comments. Thanks for watching. Don't forget to like and subscribe for more Forex insights.